This lesson is going to be a brief review on the Affordable Care Act, and then we'll talk about the Affordability Exemption and the screening tool. Okay, so just as a reminder, the Affordable Care Act states that the federal government, state governments, insurers, employers, and individuals, we all share responsibility for improving the quality and availability of health insurance coverage in the United States. It reformed the existing market by prohibiting insurers from denying coverage or charging higher premiums based on pre-existing conditions. And it also created what's called the marketplace, which is where anyone can go and buy health insurance, and you can purchase it. A lot of our taxpayers purchase it over the phone, but healthcare.gov is the website where you can also purchase it. Okay, so the shared responsibility provision of the law states that individuals must have qualifying healthcare coverage, also known as MEC, or minimum essential coverage, for every month of the year. If they don't have coverage, they have to either qualify for an exemption for that month or make a shared responsibility payment, which is basically a tax penalty for not having insurance and not qualifying for an exemption. So it's very important when it comes to the ACA that you're always using your resources. There's a section in the Pub 4012 that covers the Affordable Care Act and how to screen for exemptions, and it's super helpful, so make sure that you're always using that. So an overview of MEC. So MEC is healthcare coverage that satisfies that individual shared responsibility requirement. We do not require proof of coverage. We can just take a taxpayer's word for it unless something leads you to believe that they are being misleading. So who needs MEC? So everyone on the tax return needs MEC for every month. And keep in mind that a person is considered covered for the entire month, even if they were covered for just one day during that month. And then for individuals that were born or died during the year, they are only required to have coverage for every full month that they are alive. So if you have a child that is born in January, they only have an MEC requirement for February through the end of the year. So types of MEC. So the first category is employer-sponsored coverage. So most of the time, if someone has health insurance through their job, it's just going to be group health insurance coverage for employees of a certain organization or company. And then within employer-sponsored coverage, there are also what's called grandfathered health plans and governmental plans. So grandfathered health plans are insurance plans that were in place before ACA was passed, and so they technically don't meet all the MEC requirements now, but they are grandfathered in. So they are considered MEC even though they don't meet all of the requirements. And then governmental plans, so that would be if you are a employee of the federal government, and so they have a health benefit program. Okay, so there's also self-insured health plans for employees, and then retiree coverage. So some companies have healthcare coverage for individuals that retire from them, and then COBRA coverage, which is basically continuing healthcare coverage if you lose your job or if you have reduced hours from a job and lose your healthcare coverage. So individual healthcare coverage is going to be just insurance that you can purchase directly from an insurance company. These plans are also available on healthcare.gov. And then student plans kind of fall under this category as well. So if you're a college and your university or college offers you a student health plan, you are considered covered under an individual healthcare plan. Government-sponsored programs that are considered MEC. So Medicare, if you're covered by Medicare, you have MEC. Most Medicaid coverage is going to be MEC, especially for children. And then Children's Health Insurance Program, so also known as CHIP. In Alabama, it's known as All Kids. In Tennessee, it's called Cover Kids. In South Carolina, it's called Healthy Connections Children. And Florida Kid Care is for Florida. So all of these are going to be considered minimum essential coverage. So government-sponsored programs. So TRICARE is for military members. VA comprehensive health care coverage is MEC. Peace Corps volunteer health care coverage, refugee medical assistance, and then Department of Defense non-appropriated fund health benefits program. And then other coverage that's considered MEC, certain foreign coverage or certain coverage for business owners. So thinking about what does not qualify as MEC. So there are some health plans that might provide limited benefits but don't qualify as minimum essential coverage. So some common ones you might run into would be standalone benefits like dental or vision insurance, disability income insurance, workers' comp insurance, and then Medicaid providing only specific services. So this will mostly be individuals that have just family planning Medicaid or pregnancy-related Medicaid. And then AmeriCorps requirements for organizations that have AmeriCorps members. Their requirements are not MEC. And then AfterCorps coverage is for, I believe, members of the Peace Corps that are now back in the United States. That AfterCorps coverage is not considered MEC as well. Okay, so tax forms that show evidence of coverage. We have here on the W-2, if the taxpayer has code DD, there are also some other codes that might be in box 14 or in box 12 that are going to show healthcare coverage, and it just means that their employer is offering them healthcare coverage benefits. And then also on the SSA to 99, on the left-hand side, there's going to be information pertaining to Medicare. So you know if someone is having Medicare premiums deducted from their benefits, they are going to be covered by Medicare and therefore have MEC. So the Form 1095A will also indicate healthcare coverage, and this is going to be for anyone that purchased insurance through the marketplace. So everyone that gets insurance through the marketplace is going to have this form, and they have to have this form in order to fill out the health insurance section in TaxSlayer. A 1095C, so this is going to be issued by employers. In the employer-provided health insurance offer and coverage form, it'll basically just have the taxpayer's information and then the months that they were covered through their employer. Again, we don't require taxpayers to bring this in and show it to us, but if they do have it, it is a helpful check just to make sure that they were covered for all 12 months. Okay, so a very important part of the health insurance section in terms of the tax prep process is filling out this gray shaded portion on the intake interview form. So if the taxpayer doesn't have MEC for any month during the tax year, of course, we need to screen them for an exemption. And it's very important that we're always filling out this gray area in order to make sure that the ACA portion of the return has been filled out. And so for all the people listed on the return, you're going to indicate whether they had MEC for the whole year, no MEC for the whole year, whether they had it for part of the year, and then when you screen them for exemptions, making sure that you mark the months that they qualify for an exemption, and then making notes over here, just indicating, helping out whoever's quality reviewing that you have gone through and checked for everything. So, you know, if a taxpayer has a short coverage gap or something, you can just write in the notes, short coverage gap for whatever months. And then also up here, just making sure that they've filled these out correctly. Okay, so who needs a healthcare coverage exemption? So a coverage exemption is going to be for individuals who don't have coverage during any month during the year. And a coverage exemption is basically a reason for not having health insurance that avoids payment of the individual shared responsibility payment. So anyone without insurance coverage for any month should be screened for exemptions. Okay, so where do you start with exemptions? So whenever a taxpayer doesn't have coverage, the first question that we ask is, do they already have an exemption on hand from the marketplace? So they would have an ECN number or an exemption certificate number if they had tried to purchase insurance through the marketplace sometime during the tax year, but were told they were ineligible, but the person they were talking to screened them for this ECN number for this exemption in order for them to put it on their tax return that basically exempts them from having to make that payment. Okay, so if they don't have an ECN on hand from the marketplace, then the next question is household or gross income under the filing threshold? So if the answer is yes, then everyone on the return is exempt from the coverage requirement. So TaxSlayer will calculate this automatically, which is great, and you won't really need to worry about it. You'll just need to worry about filling out the TaxSlayer portion correctly so it calculates household or gross income correctly. So if they don't qualify for the first two, we need to see if they qualify for an exemption that can be claimed directly on the tax return, and we'll talk more about those in just a second. So for any individuals that don't meet steps 1 through 3, we basically check to see if they would qualify for an exemption from healthcare.gov. We would basically be retroactively trying to get that ECN number as we're filing the return. So if they do qualify for one of those hardship exemptions, we basically enter pending on the tax return where the ECN would go, and then we can help the taxpayer apply for that exemption through the marketplace. Okay, so some of those exemptions that are granted by the marketplace for individuals that have experienced homelessness during the tax year, they've faced eviction in the last 6 months, or they are facing eviction or foreclosure. if they have a utility shutoff notice, if they are a victim of domestic violence, or if they experience the recent death of a close family member, if they had a disaster that resulted in significant property damage, if they experienced bankruptcy in the past 6 months, if they have debt from medical expenses in the last 2 years, or if they have high expense caring for ill, disabled, or aging relative. So some of these kind of seem subjective, and it ultimately is up to the marketplace to approve or deny these exemptions. Like what is considered a high expense, or what is considered a significant amount of debt, what is considered an aging relative, what is considered significant property damage. Again, all of those kind of seem subjective, but the marketplace is the one that has to ultimately approve or deny the application for these things. So even if we think there's a chance the taxpayer qualifies for one, we should go ahead and help them apply for it. So another one is the taxpayer is determined ineligible for Medicaid because the state did not expand coverage. So this is also an exemption you can claim directly on the tax return, and this will be very common at Save First tax sites, and we'll talk more about that in a second. And then there are also other exemptions, and in the Pub 4012, there is the really long page where it has all of the exemptions listed out that you will become very familiar with, and you'll be able to kind of guide a taxpayer through looking through all of those to see if they qualify. Okay, so for household or gross income below the filing threshold, like I said, TaxSlayer does do this automatically, but just a brief overview, household income is basically the modified AGI of each individual on the tax return with a filing requirement. So if you have a dependent that has income, you're including that in household income only if that dependent has a filing requirement. And if for gross income, you are not including dependent income at all, and this is considered all the income received in the form of money, goods, property, and services that is not exempt from tax, including taxable portions of Social Security benefits. Okay, so some of the exemptions you can claim directly on the tax return. So certain non-citizens and U.S. citizens living abroad qualify if they are a member of a federally recognized Indian tribe or eligible for services through the Indian Health Service, if they are a member of a healthcare sharing ministry, if they were incarcerated during the year, if they have what's considered unaffordable insurance or the cost of coverage exceeds a certain percent of household income. This number right here does change year to year. A couple years ago it was 8.13. Last year I believe it was 8.16. So it does change a little bit year to year. And then also aggregate cost of employer insurance is considered unaffordable. If their employer did offer them coverage but it was unaffordable, they'll qualify for an exemption. And then short coverage gap, which means they went less than 3 months without health insurance, they do qualify for short coverage gap. And a full list of these exemptions are in the Pub 4012 ACA tab. Okay, so moving on to briefly discuss the premium tax credit. So the premium tax credit lowers the cost of health insurance coverage purchased from the marketplace. So the premium tax credit can either be taken in advance or taken directly on the tax return. So most of our taxpayers will have taken it in advance, which just means that the monthly payment for their health insurance was forwarded directly to the insurer in order to reduce the premiums. And so whenever you purchase insurance through the marketplace, you have the option of these two. But like I said, most people are going to take it in advance, which just means that the government sends the insurance company a subsidy on your behalf based on your income. Your premiums are basically reduced by the subsidy that you take. And then taken directly on the tax return. So the payment is basically taken as a lump sum when you file the return. So you aren't going to get a monthly subsidy to help make your insurance more affordable. You're going to pay the full monthly premium, but then when you file the tax return, it'll calculate how much of the premium tax credit you do qualify, and you just get it as a lump sum. Okay, so this is the Form 1095A, and at the bottom of the form, you're going to have all the months listed out, and you'll see in column A it says monthly enrollment premiums. So this is going to be whatever the cost of coverage was, the full cost of coverage for the insurance plan every single month. So column B, the SLCSP premium, is monthly second lowest cost silver plan. So this is basically the benchmark plan that the marketplace uses to determine the premium tax credit. And so they just have to come up basically with a number to calculate the premium tax credit in order to come up with an accurate number for all individuals. So The silver plan is basically the benchmark plan that is used to calculate the premium tax credit, which is in column C. So this is basically, this person took the premium tax credit in advance. So they got like a monthly discount for all of their insurance that they purchased for May through December. And so the monthly advance payment was $164 a month. So their premium was $196 per month. And so that means that out of pocket, they were paying $32 per month. So this payment was forwarded directly to their insurance company, the premium tax credit, and they were just left with $32 to pay to their insurance company every month. Okay, so when it comes to the premium tax credits, obviously the first question is, did the taxpayer or dependent purchase insurance through the marketplace? If yes, then you have to fill out the 1095-A information in TaxSlayer, which will produce Form 8962. And if not, then obviously you don't need to fill out the 1095-A information in TaxSlayer, because if you don't purchase insurance through the marketplace, you are not going to get that 1095-A. Okay, so then you ask, did they get the Form 1095-A health insurance marketplace statement? If yes, then you use the form to fill out the form. All members of a household in a single policy will be on that Form 1095-A. And then if they enroll in different policies or made mid-year changes, there might be multiple 1095-As. So if the answer is no, and they did not get a 1095-A in the mail, we need to call the Marketplace call center or check the taxpayer's account on healthcare.gov to get that 1095-A. So just because they didn't get one in the mail doesn't mean you can leave it off the return. So everyone that purchased insurance through the Marketplace, they have to fill out the health insurance section in TaxSlayer with that 1095-A information. So we have to get that information before we can file the return. Okay, so now we're going to talk about the Code G exemption very briefly. So remember, the steps are, does the taxpayer have an exemption from the marketplace already, like an ECN number? If the answer is no, then did their household or gross income fall under the filing threshold? If the answer is no, we move on to see, can they claim an exemption directly on the return? Okay, so if they lived in a state that did not expand Medicaid, which is going to be the Code G exemption, and they're under 138% of the federal poverty line, then they're going to qualify for this Code G exemption. So this is going to affect a lot of our taxpayers because all of the states that we operate in did not expand Medicaid under the Affordable Care Act. So all states had the opportunity under the Affordable Care Act to expand Medicaid, but a lot of states chose not to do that. And so for the taxpayers who live in a state that did not expand Medicaid, they might qualify for this exemption if they fall below 138% of the federal poverty line. And we have a very detailed screening tool that we will practice a lot with during group training in order to determine if they do fall under that 138%. Okay, so now we're going to move on to the what's called affordability exemption, which is a little bit more complicated. We're just going to do a brief overview. We're going to understand the affordability worksheet screening tool, and then we're going to understand using the marketplace affordability screening tool and healthcare.gov. Okay, so the affordability exemption, you're going to approach the affordability exemption after you have exhausted all other options. So this means that the taxpayer doesn't qualify for the filing threshold exemption, any of those exemptions from the marketplace, or any of those exemptions claimed directly on the tax return, which includes being under 138% of the federal poverty line. So coverage is considered unaffordable if the cost of coverage, either through their employer or out-of-pocket costs of marketplace coverage, is more than a certain percent of household income. So again, this percent changes from year to year, but it usually is around 8%. And household income means many different things in the tax world, unfortunately, but you guys should not have to really worry about that because the screening tool asks for all of the things that you need, and you won't really need to distinguish between household and gross income as long as you just fill out the information correctly. So if you just follow all those instructions carefully and read everything carefully, you're going to find the right answer. Okay, so when you're determining the affordability exemption, we need to be going through these certain options for each taxpayer in order to determine which screening tool that you're going to use. So basically what that means is when you are asking for a taxpayer's situation to try to determine if they qualify for an affordability exemption, You are going in order these three options, and when you get to the situation that applies to the taxpayer, you stop. You do not move forward to see if the next one qualifies. So the first option is the lowest cost self-only policy offered to each member of the household, including you, for each month. The lowest cost family policy offered by your employer or your spouse's employer. The policy must cover everyone in your tax household for whom a personal exemption is claimed, who is not eligible for employer coverage, and who does not qualify for another coverage exemption, or the amount from the Marketplace Coverage Affordability Worksheet. So I know that that is a little bit confusing, so I'm just going to try to explain it a little bit better and a little less wordy. So basically what this means is if you are working somewhere and they offer you a healthcare coverage policy and it only covers you, then you're going to see if that was actually considered too expensive by basically figuring out if it was more than a certain percent of your income, that 8% number. And then you would stop and use that number to determine if it was affordable. So you wouldn't move on to these other two options. And the reason behind that is the logic of if your employer is offering you healthcare coverage, it should be considered affordable. So if they offer you something that's unaffordable, you shouldn't have to go to, other outlets to try to find healthcare coverage because they should be offering you something that's affordable. And if they aren't, then you shouldn't be penalized for that. So if your employer offers you something and it is too expensive and it is in excess of a certain percent of your income, you will qualify for the affordability exemption. But if they do offer you something and you think it's too expensive and so you don't buy it, but it ends up actually being considered affordable, so it is under that 8% threshold, then you won't qualify for the exemption because you should have bought that insurance because it is considered affordable. Okay, so what happens if you don't have healthcare coverage offer through an employer? So let's just say your employer just doesn't offer that to their employees. So obviously this first one won't apply to you because you did not have the offer of a self-only policy. If you're in a single household, you aren't married or anything, obviously you aren't going to have the offer of family coverage because, again, your employer is not offering you insurance at all. So then you're going to see if you could have purchased it through the marketplace and whether your out-of-pocket cost for that marketplace plan would have been considered affordable. It gets a little bit tricky when you have multiple family members that you're screening for. So for instance, if I am married to someone who had the offer of a family policy that would have covered me, but we didn't purchase it because we thought it was too expensive, and I did not work somewhere that offered me a self-only policy. So I would get to this one. Did the lowest cost self-only policy apply to you? So my employer did not offer me insurance, right? So that would not apply. Did I have the offer of family policy either by my employer or my spouse's employer? So if my spouse's employer did offer a family coverage policy that would have covered me, this is the option that we're going to use. So again, you're basically figuring out which one applies to you first, and then you're stopping. You aren't moving forward to the next one. And again, the logic behind that is that your employer, if they're offering you coverage, it should be considered affordable. And if it's not considered affordable, you shouldn't be penalized for not purchasing it because they should be offering you something that's affordable. Okay, so kind of just going through some examples to determine which option to use. So Beth is 40 years old, she's single, she has no dependents, and she did not have health insurance for the whole year. She did not meet any of the other exemption requirements, so we checked the affordability exemption as a last resort. She says that her employer offered her a plan, but that it was too expensive, so she didn't purchase it. So which of the three options are we going to use? So did she have an offer of a self-only policy? Yes, right? So it says she did not meet any of the other exemptions. She said that her employer offered her a plan, but that it was too expensive. So she's not married, so she's not going to have this one. So we're going to stop right here at the first one. So she had the offer of a self-only policy to her for the year, and so that is the option that we're going to use to try to see if that is considered affordable or not. So we're going to check and see if that self-only coverage plan is considered unaffordable. Basically, was it more than a certain percent of her income? And so the way that you'll determine this is the taxpayer they'll have to figure out how much it would have been monthly or weekly, and then we'll figure out the annualized premium, basically how much it would have cost for the entire year. That information, most of the time taxpayers do know it off the top of their head, how much it costs per month or per week, but sometimes they will have to call their employer to figure out how much it would have been in order to determine if they qualify. Okay, so we have Tim and Susie who are married and have no dependents. Neither of them had health insurance for the entire year. Tim's job offered him a self-only coverage plan that he said was too expensive. Susie's employer did not offer her insurance at all. They don't qualify for any other exemption, so what options are they each going to use? So remember, you're going through all three options for each person individually on the return. Okay, so let's talk about Tim first. So which option is he going to use? Did he have the offer of self-only policy? Did he have the offer of family policy? Or are we going to use the marketplace tool? So he had the offer of self-only policy, so he's going to use this first option. So we're going to see if that self-only policy was or was not affordable. And then let's see, Susie's employer did not offer her insurance. What option is she going to use? So she did not have the offer of a self-only policy, and she also did not have the offer of a family policy either through her employer or her spouse's employer. So it says he was only offered a self-only plan. It doesn't say anything that he was offered a family plan that would have covered her. So she's not going to use this one, which means she's going to use the third option. So we're going to see if she should have purchased insurance through the marketplace and would that have been considered affordable. Okay, so we have Charlie and Cindy, and they have one son, Chris, who's 7. Cindy's employer offered her a family policy that would have covered Charlie, Cindy, and Chris. She declined to purchase it, saying it was too expensive. They do not qualify for any other exemptions, so we look to the affordability. Which option are we looking for? So remember, we're asking the question for each person individually. So let's talk about Cindy first. So was she offered a self-only policy, a family policy, or are we going to look at the marketplace? So it says she was only offered a family policy. She was not offered a self-only policy. So we aren't going to use that one, and we're going to use this one. All right. So her husband, Charlie, he was not offered a self-only policy through his employer, but he was offered a family policy through Cindy. So he's not going to use this one. He's also going to use this one. And then we also have to ask the same question about the son. So even though it's silly, and it probably will never be this first one, self-only policy for a child, because they don't work anywhere and they don't have the offer of self-only policy from their employer, because again, they don't have a job, we still have to go through these. So this first one won't apply to him, and then we basically say, was he offered a family policy either through his employer or the spouse's employer? And also, when it's talking about this, it also means like, you know, your parent or whoever is like claiming you on the tax return. Okay, so he's going to use this option as well. So they're all going to use the second option to see if that family plan was considered affordable for them. Okay, so I'm just going to briefly show you guys the screening tool. Okay, so this is the screening tool that we are going to use. So it says here, ACA exemptions related to income tool. So this tool is really great because it screens for that Code G exemption and also the affordability exemption, and it tells you when you need to stop and when you need to move forward. So again, we're going to have lots and lots of practice on this during group training, but for right now, I just want to give you a brief overview. So it just asks questions about, obviously, the state, because it needs to know if you lived in a state that did not expand Medicaid. It'll ask for your filing status. We'll just say we're a single taxpayer. It'll ask if you're over age 65. And then total number of people in the tax household. So I'm just going to say I am a single taxpayer, no dependents, and then this is where you start entering in the income information. So it's very important that you are doing the Affordable Care Act health insurance section at the very end of the tax prep process, because you need all of this information to be correct on the return. So you obviously need to wait until you've entered in all the income, all the expenses, everything in order to get the accurate numbers for this. So let's say I have entered all of the income for this taxpayer and I've pulled up the 1040 in TaxSlayer, and they have a AGI of $11,000. And they don't have Social Security income, they don't have any of this. So here's my household income, $11,000. You'll notice here it does have a place for dependents, again, only if they have a filing requirement. So you would fill that out if they had a dependent with a filing requirement. Okay, so it says here, test for exemption for income below filing threshold. And you will notice that it says here, also calculated in TaxSlayer, is income below the filing threshold. This says no, exemption does not apply. Continue. So now it says test for Code G exemption, Medicaid coverage gap. 138% of the federal poverty line is $16,394. Household income for me is $11,000. Is my income less than that percent? Yes, enter Code G. So again, if I get that exemption, I don't need to move on to affordability because I already qualify for an exemption, and this can qualify for the entire year. All right, so I'm going to just reset this, and I'm going to say that my AGI is 20,000. All right, so now I'm above that 138% line, and it says no, Code G does not apply. So now I need to go to the affordability tool. And it says 8.16% of income is $1,632. If offers of coverage, family composition, or location of family members change during the year, you may need to run this section more than once for selected months. For example, if a taxpayer had no coverage offer at the start of the year, then in June gets a new job with an offer of coverage, determine affordability separately for January through May and June through December. In all cases, you need to use the annualized income above. So basically what this means is you're only using the annualized premium for the months that you actually had the offer of that annualized premium. So again, in this situation, like in January through May, if they weren't working and didn't have the offer of employer coverage, we're going to use a different calculation for those months than we are for the months where they did have an offer of employer coverage. So okay, does the taxpayer or spouse have an offer of self-only coverage from his or her own employer? If yes, determine the offer's affordability and stop for this individual. Okay, so these are those three options, right? Self-only, family, marketplace. So let's say that this taxpayer did have a self-only coverage offer, and it tells you to enter in the premium per month. So let's say they were offered a self-only plan that was $150 a month. It'll tell you right here, their cost of self-only coverage is unaffordable. Code A applies to taxpayer. And so in TaxSlayer, you'll select the option where it says, self-only offer of coverage is considered unaffordable, and it'll select the right code. Let's say I did not have the offer of employer coverage. And because I'm a single taxpayer and I'm not married, I also did not have the offer of family coverage either through my plan or through a spouse's plan. Then it says, if there is no employer offer, is the cost of marketplace coverage unaffordable? You're going to get lots of practice using this health insurance marketplace lookup tool, but basically what you're looking up is, could I have purchased insurance through the marketplace and would it have been considered affordable for me? So on the healthcare marketplace tool, you're just selecting the tax year, what state you lived in, how many people were in your household. I'm going to enter in my birth date. It'll ask whether you use tobacco or not. So you should always ask the taxpayer if they do use tobacco, because it'll actually make their premium higher. So it is actually more beneficial for them for this purpose, obviously, to use tobacco, because it'll make their premium higher and give them a better chance at having an unaffordable premium. But anyways, ask them if they do use tobacco and then mark that accordingly. And then what zip code did they live in? And you'll select the county. And then it'll say how many months did they live there. So I'm just going to select all the months. And then you're going to select the months they were eligible for employer coverage or another coverage exemption. And the reason it's asking this is because if you had employer coverage or you were eligible for it, you don't need to be using this tool. So it's just double checking and making sure that you're here because you need to be here. Okay, so if I did not have the offer of employer coverage for all year, I'm not going to obviously select any of these months. And even though this just say was eligible for employer coverage, that also means had employer coverage as well, because if you have employer coverage, you were eligible for it. So like, let's say I was covered through my employer for January through March, and then I lost my job and I didn't have coverage the other months, then I would select that the months that I had the offer of employer coverage or that I had employer coverage. So, okay. So again, I'm going to say that I did not have the offer of employer coverage for the entire year. Then it says select the months that they were eligible for coverage outside the marketplace, like Medicare, Medicaid, or CHIP. So if you are eligible for Medicaid, then you should not be using this tool as well. And so most of the time, you know, you've gotten to this point, which means they're above 138% of the federal poverty line. They don't meet the filing threshold and everything. They aren't going to qualify for Medicaid. So most of the time, you're just going to leave this blank. But if for whatever reason the taxpayer knows that during the year they were eligible for Medicaid during part of the year or something like that, then you would mark the months that they were eligible for Medicaid, because they should have gotten Medicaid if they were eligible for it. Okay, so then it just asks to review your information. You can add household members. So for this screening tool, even if everyone on the return, you know, you have 3 people on the return and only 1 person is using the screening tool, you're still filling out the entire tax household using this tool. So if I had 3 members of my tax household, even though I was the only one that needed a coverage exemption, I would still add the rest of them. Okay, so I'm just going to click continue. And then it's going to tell me the silver plan and the bronze plan here. So on the screening tool, it asks me for the lowest cost bronze plan. And I'm making sure that it just is the same every single month. And so I'm going to enter $277.34. And it's doing all of these calculations of my household income. It's pulling all the information using my income and the worksheet. And then I'm entering in the silver plan, which is $385.24. Okay. Let's see. So this is saying down here, this is the output that you're looking for, annual cost of marketplace coverage. Marketplace coverage is affordable. Code A does not apply. So right here, it's saying $0. So what does that mean? What this means is that I'm in the best of income situations for the marketplace. I could have gotten marketplace insurance and I would have qualified for the premium tax credit that covered all of my insurance. So I probably would have gotten it for free. So if I had purchased insurance through the marketplace and I had told them I'm a single person and I'm gonna make $20,000 this year, the premium tax credit would have covered all of my premium and I would have only paid $0. Like, I would have gotten it for free. I would have not had to pay the insurance company anything out of pocket because the premium tax credit would have covered all of it. So that's what this number is telling me. So this is saying code A does not apply, which means I should have gotten healthcare coverage through the marketplace because it would have been considered affordable, which means that I will be subject to the individual shared responsibility payment because I don't qualify for an exemption if it tells me that the exemption does not apply. And again, there are varying degrees of difficulty using this screening tool, especially when you have multiple household members, and we'll be doing lots and lots of examples during group training in order to get you more familiar with using the screening tool, but that was just a brief overview. And that's going to conclude the affordability exemption.